Well, hello, everyone, and thank you so much for joining us today for a very exciting presentation on how you can earn passive income through mortgage note investing, working with Alamo Mortgage Holdings. Now, before I go through this presentation, I need to give a disclaimer. I'm going to do that quickly, and then we'll move through the presentation, and then I'll open it up to questions at the end. So first of all, as accredited investors, you will be aware that all investments carry some level of risk. This investment is only available to investors who are able to assess their own appetite for risk. Please read the risk statement within the investment memorandum before investing. All right, well, fantastic. Now that we've done that disclaimer, let's talk about the financial product. So Alamo Mortgage Holdings, the mission of Alamo Mortgage Holdings is to provide passive income by purchasing real estate-backed mortgage notes. And we focus actually on the state of Texas. So we don't buy all over the United States, we just buy in Texas. We provide our investors and institutional partners with long-term passive income. Our company actually oversees and manages directly all of the servicing and collection of the debt. So our passive investors enjoy totally passive income with none of the work. We offer a fixed income loan note. We have a suggested investment amount of £100,000, but we can work with you if you are just starting with us and you want to start with something smaller. If this is the first time you've worked with Alamo, we can accommodate that. We're happy to have new investors come in. And then the term we offer is 3 to 50 years, and I'll talk about that 50-year term, how that works a little bit later. The team that we have has 200 years of experience with 100 years of experience in the mortgage note industry. And now I'm going to briefly introduce the team. You can also go to our website and read substantially more information on their background, but I want to kind of give you an idea of what is there. And this is something where you can earn 8% per annum, paid biannually. We can do biannually, or if you need something, we can work with you. So let's start. So about myself, my name is Benjaminzmiller, and I am the managing director of Alamo Mortgage Holdings. Our team members have successfully managed or are currently managing investment funds, companies, and real estate projects worldwide, and we've overseen up to $1 billion in financial assets. Members of our team have also worked with clients, including BG Group, Bissell, and Everett's Inc. As for my background, I'm a businessman, so I've been doing business many years. I run a few different investment funds. I have actually, in the mortgage space, I have received in-person training from the largest private note buyer in the United States. His name is Eddie Speed, and he has personally purchased over 50,000 mortgage notes over his career. Probably by now, it's over 100,000. So you've got a team with 200 years of experience that's working for you. And it is something that is so important. Now, Marina, she is our international investment coordinator. She actually speaks 5 languages, and that is a benefit because if you want to communicate in a different language, she can help with that. She's a graduate from the EU Business Skills School. She's very talented, and she loves to work with clients to answer their questions. Scott Wynn is an American. He's actually a veteran of the mortgage note industry. He has 30 plus years experience in the mortgage space, and he's a specialist in what are called junk assets. Let me explain what that means. Junk assets are assets where maybe the borrower is not paying on time. He is very skilled at working out arrangements to be able to get the borrower to pay on time, and also to find a modification, maybe a loan modification, to help the borrower where they can stay in the property, but sometimes if it doesn't work out, he's able to work out other solutions like maybe a deed in lieu, or worst case would be a foreclosure. Fred Hobbs is our director of mortgage servicing. Fred is a licensed mortgage originator in the state of Texas. He has been active since the year 2000. He has personally originated thousands of seller financed mortgage notes, private money residential notes, and his company, Secure Net Loan Servicing, they handle the servicing for Alamo Mortgage Holdings. They service Secure Net Loan Servicing is servicing now approximately 2,000 mortgage notes, and they do such a great job. They're a really fantastic company, and we're lucky to have Fred and SecureNet. They're really, really great. David Jones is a licensed real estate attorney in the state of Texas, and he is involved with when we acquire a note, when we purchase a mortgage note so that we can pay our investors passive income. He looks over all of the legal paperwork, makes sure everything is done correctly so that we have a good, valid mortgage note. He's a third-generation attorney, and he's someone that I have worked with many, many years. He always does a great job. Anna Kulikova, she is a specialist with investor relations. She actually is from Moscow, but she speaks several languages, and she loves to work with investors to help them get the passive income goals they are trying to reach, to design a plan. Mark DeRuyter, he is our Chief Technical Officer. And Mark actually has a lot of experience in the mortgage industry, writing financial services software. He's been involved with that for many years, and he brings a lot of skill to that, where he can help with putting together the information in a way that we can keep track of everything. He's very talented. Now, how does this work? How do you make money? Well, we pay 8%. It's so simple. We pay 8%, and we offer an option of a 3-year bond, a 5-year bond, and a 50-year bond. Now, a lot of people, when they see that 50-year bond, they think, why such a long bond? Well, folks, you don't need to buy a 50-year bond. That product is more designed for institutional investors, where in their bond portfolio, they're trying to do something with duration. So we have that product available, but an individual also is welcome to do that. If you're in the situation where you want to ensure maybe a long-term income stream for your family or for something like that, these products can be really excellent. So 8%. Now let's get into what is so important. And this is something that I want everyone to understand. I want this to be crystal clear. I want it to be clear as a bell. What is the improvement on purchasing passive income with Alamo versus a UK gilt? Now, let me explain, if some of you are not from the UK. A gilt is a bond. It's a United Kingdom government bond. So I'm going to show a short clip here, and it'll give you an idea of how much more you can earn with Alamo Mortgage Holdings compared to one of those gilts.
And today I want to talk about something that is very interesting. And this is, if you are an investor that's an accredited investor in the United Kingdom, you may be wondering what is going on with the 30-year Treasury gilt yield. So let's take a look at this and talk about it for just a minute, and then we'll compare it to Alamo Mortgage Holdings, our yield. And I'll give you a hint. Alamo Mortgage Holdings has a far, far higher yield. So if we were to go back to, say, the year 1980, the highest that we have here is around 1981. The yields were running about 13, almost 14, 13.5, 14%. And then you notice how over time, the general trend has been largely downward. I mean, we look here and we see that the yield as of, for example, 2016, if we look at 2016, the yield's like 1.4%. And then if we go all the way down to May of 2020, the yield fell all the way down to 0.57%. Now it's starting to slowly go back up. And as of this video, December 2022, the yield was at 3.678%. So let's just kind of compare that. Let's imagine that you buy gilt, you would get a 3.68% yield if you were to purchase a 30-year gilt. But now imagine that you instead decided to purchase an Alamo Mortgage Holdings bond. How much would you make? Well, that is a great question. I'm happy to answer it. So basically, with an Alamo Mortgage Holdings bond, you'd be getting right here at 8%. That's a tremendous improvement over what you can get on a gilt. Now, I know a lot of people are going to say, but a gilt has a zero default risk. I get it. I understand. But here's the thing, folks. You're getting such a low return on a gilt that you may want to consider if that actually makes sense to you in terms of what you're dealing with there. Because if you were to instead purchase an Alamo Mortgage Holdings corporate income bond, which is the bond of a UK company, you'd be earning right at 8% yield. And if we were to go back in time, you wouldn't have seen a yield like that for many years. You would have seen the last time gilts were giving an 8% yield was looks like it was right around let's see, when was it? 1996, so almost 30 years. So in the last 30 years, it hasn't gotten close to an 8% yield. So that's worth thinking about. If you would prefer to get an 8% yield, and you understand that it's not a government-backed guarantee. It is backed by collateral, though. It's backed by mortgages. It's something that you definitely should consider. Be happy to chat with you about what Alamo Mortgage Holdings can do for you in terms of providing passive income. And I wish you a fantastic day.
Okay, very good. I wanted to make that clear to everyone how that works and what is the gain that you get by making the wise decision to purchase an Alamo Mortgage Holdings corporate income bond. But I want to really drive this clear, because a lot of investors in the UK, and I respect them and I understand it, but I want them to think about this, because a lot of times when you're in the United Kingdom and you're thinking in pounds and you're getting a rate of return that's a certain percent, you may not be thinking about a couple factors that are so important if you're purchasing gilts. And I just encourage you to look at this, because this is some very important information for our investors in the UK. Now, let me go through this here. If you're looking to purchase gilts, let's say you're looking around and you bumped into this video and you're looking to purchase gilts, you probably are in the situation where you want a reliable way to obtain passive income, and gilts would fit this requirement. The problem with gilts, though, is they are denominated in British pounds, and the pound has a decades-long history, a tradition of losing value against the US dollar. Another problem with purchasing gilts is that the returns they offer are lower than corporate income bonds. They're always lower. Interest on all registered gilts is payable gross without deduction of tax. Holders of gilts on the register maintained by CIS may opt to have tax deducted at source by applying to CIS. Gilts, of course, have their merits, and for an investor, this is important. Gilts have their merits, and for an investor that can turn a blind eye to the higher rates of inflation. So if you're the type of investor that can see all that high inflation in the United Kingdom and you can just shut your eyes, turn a blind eye and say, I don't see it, that is one of the requirements. The second requirement is if you can also, with your other eye, turn a blind eye to the weakening British pound. If you can just ignore that for decades, your pound has lost value against the dollar. Ever since Bretton Woods, it's lost and weakened against the US dollar. Then if you're that type of investor, then yeah, you can accept gilts and you'll get paid on time and you'll get some passive income and it'll be great. And they're index linked and you can go to sleep and just, you turned a blind eye on both of the problems and hey, everything's good. Yet the fact that gilts are easier to purchase and more well-known does not mean you will earn as much interest. If you were to instead purchase my company, Alamo Mortgage Holdings, we offer a corporate income bond. If you were to purchase a corporate income bond through Alamo Mortgage Holdings, you could potentially earn hundreds of basis points more per year on your corporate income bonds than those old gilts. If you're interested in purchasing a bond, you can contact me directly. So that is just so important. And I want to show something that is that really makes it crystal clear. Now, and what I've got is the next thing that I want to show is I want to actually show how the exchange rate has moved. Now, this is something that's go through this. Now, we'll go through that in a minute. We'll go through that in just a minute, but that's very important. Now, another thing that people ask about is, that sounds great, the idea of, for example, buying these notes. Look at this exchange rate. Look at this exchange rate. Back in 1945, one British pound could purchase $4.03 American. That's back in 1945. When Bretton Woods Agreement was first put together towards the end of World War II. So now look at what has happened over time. The pound just keeps over the decades losing. So if you went to 1967 and you pulled out a British pound, you could only buy $2.40, not $4.03. If you went to, for example, 2007, you could only buy $2.05 US. If you went to 2010, by 2010, one British pound could only buy $1.59 US. And finally, if you were to look at the first of this year, January 2023, one British pound only buys $1.21 US. Now that's something that really should be thought about because the inflation is one thing that gets the investors. And the second thing is that exchange rate movement. And with Alamo Mortgage Holdings, we've got some solutions here that we can offer on this to actually provide realistic solutions. So the way it works is we purchase a mortgage in the United States and we pay passive income to our investors. So let's imagine that this mortgage is $100,000 and it pays a 10% rate of interest, and we negotiate and we purchase it for $70,000 from a motivated seller. Now, later in the presentation, I'll talk about how that happens, and I'll also talk about why anyone would pay 10% on a mortgage. I know it's the people here are not paying those kinds of rates, but there's a market that does pay those sorts of rates. So in that, you would get 70,000 note. Well, the yield on that note has increased to 14.2%. 14.2%, and that makes it easy for us to pay 8%. So there's a wide margin of safety. So that is so important. Now let's talk about what actually determines the value of a mortgage note, because I like people to understand this, and it's something that's so important. So then what determines the value of mortgage debt? Because we know what determines the value of real estate. Real estate is determined by the value of a particular flat or house. It's determined by what are comparable houses and flats. What do they sell for? That determines the value. If it's a commercial property, it's determined differently, where it's determined by the cash flow on the commercial property. But for this example, if we talk about a mortgage note on, say, a property of maybe a residential home, there's six factors that determine the value of a mortgage note. The first factor is the buyer. So if you had a choice between buyers, say you have a property and you're trying to decide who to sell the property to, and you've got one person that is a government employee, and that government employee has a high salary. They've been working for many years for the government. Maybe they work as a post office person. Maybe they deliver packages for the post office, and they've been doing this for 10 years. If the government is their employer, there's the very high probability they're going to get paid on time. But if you have another buyer that says, I'm 24 years old and I just started my new company and I'm just going to make a bunch of money with my company, and they don't have a regular income, but they have a plan where they're going to make money in the future, that sort of buyer is far less desirable. It's better to sell the asset to one that has a regular government income, the government employee, or the one that works at some sort of a big corporation. Maybe they work at Microsoft, maybe they work at Google, maybe they work at some big corporation. That buyer is more likely to be able to pay, where they are not going to have cash flow experiences where the things are up or down. The second thing that determines the value is the collateral. So the collateral means the actual asset. So let's say that the property is worth 100,000. Say that's the market value. That's the real value, 100,000. But say that you had a seller that he sold the property with a note for 200,000. Pretend he found somebody who didn't know the prices, and that person agreed to pay 200,000, even though the market value is only 100,000. You have to treat that note differently, because the fact that he found somebody that signed a note and the asset's only worth 100, but he found someone that signed a note for 200 does not make the note worth 200. You could look at that note and you could base it on the value of the collateral. So that's a mistake, is a lot of times people don't look at the collateral, they just look at the value of the debt. And when they see the value of the debt, they may not have properly analyzed what's the collateral worth. The third factor that drives the value is the down payment, the money that the buyer initially paid. So let's say you had two buyers, one that put 30%, 40% of the purchase price, where if it was 100,000, maybe that buyer put down 30,000, 40,000, 30 or 40%. And then say another buyer said, you know what, I want to buy this. I'll pay you the 100,000, but I only have $1,000. I only can put down 1,000. Can you finance 99,000? And the seller agreed. So they both agreed to buy the asset for 100,000, but one of them put down 20,000. Another put down only 1,000. The one that put down the larger down payment is better, because there's less risk of the person saying, you know what, I don't want this. I'm just going to leave. I'm just going to move. I'm just going to, do, because he's got virtually nothing to lose. He lost $1,000, his down payment. But the one that put 20,000 or 30,000 down, he lost a lot more if he walks away from the deal. So that's why you look at the buyer's equity or their down payment or their upfront money. That's an indication of the value. So a buyer that puts down 10% is better than a buyer that puts down 1%. The fourth thing that's important is the actual interest rate, the interest rate on the note. So if you have a mortgage debt that pays 10% or 12%, that is better than a mortgage note that only pays 5% or 4%. So if you had a choice between two mortgage debts, and the first paid 5% and the second paid 10%, the one that paid 10% is better. The next factor that drives value is the history of the payments. So when you buy these mortgage debts, you want to look at how long has the person been making payments. You want to be careful buying a new note. You want to see a record of how long the person has been making payments. So if a person has a 30-year note, and they are 4 years into a 30-year note, where they still have 26 years left, that is safer if you see a record of payments compared to a 30-year note that the person put the down payment down, but they haven't yet made their first payment. Because what if the person just walks away? What if they don't make that payment? Then you've bought a note that is a non-performing note. You want to buy a performing note. A performing note is more valuable than a non-performing note, because then you don't have any work to do. You just buy the note and the borrower makes payments to you. So a performing note is better, and the history of performance is important. The next factor that drives value, the sixth factor, is the actual paperwork, the legal paperwork, if it was done properly. Because if you have a note that was just two guys that were sitting around a kitchen table and they worked out a deal and they wrote it up without a lawyer, where they just wrote up an agreement and they signed it, that is less valuable because the note likely has mistakes. They're not lawyers. They just agreed that, yeah, I'll make payments to you for 30 years. Did they remember to put in any of the legal language? Did they know how to put any of the legal language in? These things are important. That type of note is less valuable than a note that had a proper closing at a legitimate company with legitimate lawyers that drafted the paperwork, because you know that it's very likely that if you buy that note and the borrower doesn't make payments to you, you have legal recourse. You don't want to buy a note that hasn't been drafted properly, that doesn't have proper legal paperwork. So very important there. Okay, fantastic, fantastic. So that's actually what drives the value of a note. And that's something that's important in note buying. Now I'm going to go through an example here. This is not an asset that we have in our portfolio. It is an example that's shown to demonstrate how these notes might be created. So here's a property that's being offered for sale in Texas. The price on it's $120,000. Let's imagine that the seller tried to sell it and nobody came forward to buy it. And then, but one buyer came forward that said, hey, I'd like your property. I'll buy it. I'll pay you the $120,000, but I've only got $20,000. Can I buy it? And the seller's like, no, you need to go to the bank. I know a good banker. He'll make you a loan. Go talk to him. He'll make you a loan. So then he referred him to a banker. The banker looked over the buyer and said, well, you're self-employed. Well, you don't have a high credit score. We're not going to make you a loan. You don't have everything in order. So then the buyer came back to the seller and said, listen, the bank wouldn't do it. I really would like to buy this. Could you loan, let me make payments to you every month. I've got a job. I'm working hard. I want a place for my family. Let me make payments to you. And the seller looked at it and said, well, I could do that. I don't really need all the money right now, but I need to get an interest rate. I can't make you a low interest rate. I'm not going to give you an interest rate like a bank would. I'd need 10%. So they agreed on 10%. And then basically imagine that 5 years have passed. The seller got the $20,000 from the buyer. The buyer has been making payments like clockwork of $877.57. And now imagine that the seller is in a situation where he wants or needs cash. And when that happens, he has a liquid note, which is not easy to convert to cash. So he would contact a company like Alamo Mortgage Holdings, and we could purchase that note. And on that sort of thing, let's imagine that the maximum would be 12% yield. So the highest offer, the unpaid balance on the note after 5 years of payments is $96,574, even though the original note was $100,000. Why did it go down? Well, as you know, with the mortgage in the beginning, the first few years, the majority of the payments are going to interest, not to principal. So that's why it has such a high unpaid balance. But Alamo Mortgage Holdings could make an offer up to, for example, $83,322. And that is, in that situation, if that transaction occurs, the investment to value is 69%. So there's 36,677 in equity. It's a very safe thing. I mean, if the buyer stops making payments, I mean, it's almost a great situation for us if they don't pay. Now that's a joke. We don't actually want to take the property in foreclosure, but if we needed to, we want people to succeed with their loans. We want them to enjoy their properties, but we have a margin of safety, and that is so important in investing. So we talked about this. Now I want to show an example of what does it mean? Why Alamo? Well, we offer diversification. We actually purchase packages of mortgage notes. I'm going to show you a real portfolio here. This is a real portfolio of mortgage notes for anonymity purposes. Some of it has been blurred out where you can't see the actual people's names, but this will give you an idea.
So this right here is actually an example of what a portfolio of loan notes might look like. So this is actually a real portfolio. And you look here and you can see the name of the borrower, the number of months. You can see the interest rate. This debt is actually pretty high, 14.75% is what they're paying on that mortgage. The monthly payment is $278.50. Then you can see the terms, the status, this sort of thing. So, I mean, you've got a list here, and this is an example of a package where a package of these mortgages can be purchased. This type of deal would be done by a larger investor. It would not typically be a single investor that would buy this package. For example, my company, Alamo Mortgage Holdings, this is the type of package that we might actually purchase, something like this. But if you're just starting out in investing, you might start out by you're just going to buy one mortgage note. So for example, you might come in and this mortgage note, if you find something like this out on the market, you might try to negotiate down from, the unpaid balance at $89,570. Maybe you try to buy it for $59,000 or $69,000. But that would be one note. But you can also purchase packages of notes. And that's something that Alamo Mortgage Holdings is involved with. It's a company that's a United Kingdom company that actually purchases packages of mortgage notes. So wanted to give you an idea of what a package of notes looked like.
All right, fantastic. So that's one of the big advantages that we'll go through. We also buy commercial notes. Since we're short on time, I'm not going to go through that part of the presentation, but if anybody has questions, you're welcome to contact me and I can describe how we also buy commercial debt that's secured by commercial assets like buildings. So why bonds? This is so important because I get asked sometimes by people, what about their portfolio? Well, the thing about that is one thing that I very often see is they tend to have, they've got some cryptocurrency. Everybody loves that cryptocurrency. They've got some stocks, but a lot of times they don't have a very high percentage as bonds in their portfolio. So this is something that is so important. And rather than giving my opinion, rather than saying what my opinion is, I'm going to talk about a Nobel Prize winner. I'm going to tell you about Harry Markowitz. He actually won the 1990 Nobel Prize for economics for his contributions to what is now called modern portfolio theory. But it's interesting, folks. When it came to his own investments, Markowitz, he actually took a very simple approach. You hear so much about modern portfolio theory and efficient markets and all these things. But when it came to Markowitz's own portfolio, he said, and I quote, "I visualized my grief if the stock market went way up and I wasn't in it," meaning if he had all bonds. If it went way down and I was completely in it. So this is something where he was trying to find a solution. And what he did was he split his contribution 50% in stocks and 50% in bonds. And then he would kind of adjust that once a year. He would just make an adjustment where, he might get if the stocks had gone up a lot, he might acquire more bonds and vice versa. So I'm not telling you that you should do that. I'm just pointing out that's what a Nobel Prize winning economist, what he did with his own portfolio. And it might be worth thinking about as if you look at your own portfolio and you figure out what percentage of your portfolio is in bonds, you may want to think about this. So now why Texas? Okay. First of all, Texas is a state that is growing. We have people moving in from California. We have people moving in from New York. Texas is growing, and that creates more demand for real estate. As more people move into the state, the real estate prices are pushed up higher, and that benefits us, and that benefits our bondholders, because the more the value of the assets increase, the safer our loan portfolio. So it is a fantastic situation. We also have, a focus on Texas. We're not trying to buy all over the United States. That's a mistake that sometimes people make, where unless they're real experienced and they really know what they're doing, it can be tricky because the US states have some different laws, So it's easier to focus on one thing, and we're focused on Texas. Now, what are the advantages to you? Well, the first advantage is you can reach your passive income goals more quickly. And folks, no matter what your passive income goals are, if you want to get 5,000 pounds a month, 10,000 pounds a month, if you want to get 100,000 pounds a month or more, we can help you with that. That is one of the great things about working with us, is we can design a plan to get you to that passive income level that you're looking for. Another advantage is maximum diversification. We offer maximum diversification. We all know in investing how important that is. But since we are acquiring not one mortgage, but packages of many mortgages, you have maximum diversification, where if one loan doesn't pay, we can remove it from the loan portfolio and we can replace it with a loan that is paying. So we also offer no fees. Now, folks, I know in this world that we live in today, you guys have heard from maybe some of the hedge fund guys, maybe some of the private equity guys, and they love their fees. They like to talk about 2 and 20. They just love fees. Now, I am not saying that those guys don't deserve their fees. I've got friends that are in that business, and I am definitely not saying they don't earn their fees. I'm just saying that if you would prefer an investment where your money is not going to those fees, Alamo Mortgage Holdings has a solution for you. And if you look at the rates on private equity, you're looking at 1/3 of them fail, 1/3 of them break even. So, and then 1/3 of them win. So those high fees and those failure rates, it just depends. Everybody's got to make their own decision, but I wish people would look at the failure rates of hedge funds and private equity. A lot of times in investing, being a bit more security minded and careful can get you further. So just something to think about there. Okay, so how does it work? It is so simple. You invest 100,000 pounds. That's our suggested minimum. And again, if you're a new investor and you're coming in and you want to start with something different, we'll work with you. We're easy to work with. And then you get 108,000. If you invest 100,000 for 5 years, you get 140,000. So you get 40,000 in interest, and then you get your 100,000 back. And if you go for the 50-year term, you invest 100,000 and you get 400,000 in interest and your 100,000 back. So lots of options on there. It's very simple. Now, why should I invest in the notes? Sometimes people wonder about that. Well, I believe that an investment is suited to investors that are seeking an above average return on their investment. So if you're the type of investor that's just like, oh, I don't care, I'll just get average, I'm just going to go buy the average, I don't want to think, this is not a good investment for you. You could instead buy gilts. If you're willing to take an average return, and we looked at how low those gilts were, 3.6, 3.7% yield. If you're willing to accept that, then you can just buy that. But if you want above average, if you think you deserve more than average on your rate of return, this is an investment that can potentially pay you significantly more, hundreds of basis points more than average. Another thing is, if you prefer an investment that is asset-backed, if you prefer an asset-backed investment, Alamo Mortgage Holdings offers asset-backed. If you're looking for passive income, that is our entire business, providing passive income. How long-term is the note? Well, you've got a choice of 3 years, 5 years, or if you're trying to get a really long-term income stream, you can buy the 50-year. Can you put the note into your SIP, your self-invested personal pension? Great question. That is actually up to your SIP provider. So talk to your SIP provider. I can't see any reason that they wouldn't let you. And if you have an issue with your SIP provider not helping you with that, call us. We know a lot of other SIP providers that would be happy to have your business. And we can definitely help with that, with an introduction to another SIP provider if yours doesn't understand what we're doing. What type of investment is this? Well, these are corporate income bonds. You're not buying a UK government bond. This is a UK corporate income bond. Is it a regulated product? No, this is not regulated. And actually, that's part of the reason that we can pay such high returns. There's an expense involved with going through the registration process. Boy, the legal expenses can be significant going through a full registration in the UK. And instead of all of those expenses, we are able to pay out higher returns. And again, this is a product that's designed for the accredited investors. Who can invest? Well, one of the requirements is you have to be over 18 years old. And the good news is, from this crowd here tonight, it looks like everyone is over 18. So we have that. That's great. The second thing is, how is the money protected? Well, we actually do multiple layers of security and safeguards to protect investors' capital. And we can discuss that in a one-on-one call. We're short on time here, but can you invest through a company, and are joint applications permitted? Yes, you can invest through a company, and joint applications are accepted. How is a loan note different from a government loan note? Well, that one is just that you're actually investing with a corporation. How's the tax managed? We pay all the money to you. We pay all of the money to you. We don't take out money. We just pay all of it to you, and then you and your accountant can decide based on your marginal tax rate what is the best on it. But we just pay everything gross. Are there any limits on how much I can invest? Well, that is a great question. And wonderful thing about the mortgage market is we are set up to work with institutional investors that are looking to place larger sums, and we can work with them on developing a plan. We suggest for our individuals a minimum of 100,000 pounds. Of course, if they want to do £1 million or 2 million pounds, we can definitely accommodate that. There's no upper limit. And that's one thing that really is great. Can you get access to the money early? No, folks, no. You must be very certain that once you purchase this bond, you're not going to need the money until the term expires. This is not like day trading where you can just log into your brokerage account and then, stock went up, stock went down, you're going to sell at a loss. These investments are illiquid, and we plan it so that at the time it's to be redeemed, we have the cash available to pay that redemption. Some people, they like to just keep the money working long term. That's part of their strategy, and we can accommodate that also. So how can you invest? It's easy. Just contact me. My phone number is +1 for the United States, and then 817 area code 203-4160. And then we can have a discussion, and we can talk and get to know each other a little bit better. And then after that, there's an information memorandum and a full application. But we make it easy. That KYC stuff, we follow all of that, but we make it so easy for you because we want your business, folks, and we're happy to work with you. So very good. That is our presentation for tonight. So I'm going to stop the recording, and I will be happy to answer any questions. Let me just stop this recording, and then I'll take questions here.